What's up, guys? Welcome back to the Real Take Podcast, where we are going to share our take on all things real estate. Today, we're going to be diving into some updates to the 2026 conforming loan limits. We're going to be talking about the president's proposals for introducing portable mortgages. He's also even hinted at the idea of even doing 50-year mortgages. We've seen some increases in homeowners insurance premiums, and we also are going to be talking about the Mom Donny Effect, because if you have been keeping up with all the drama going on in New York City, you're definitely going to want to check that one out. But without further ado, I have two people here that are way smarter than I am. What's up, fellas?
What's good?
What's up?
Happy to be back, man.
I thought we weren't going to bring up old stuff. Okay. We're going to act like we never left. Remember?
Yes.
I've been sitting here the entire time. I've been waiting for you guys.
Right. We've been seriously.
Yeah. I'm wearing the same exact shirt, same hat.
Exactly. I've been right here. So happy Thanksgiving, Merry Christmas, Happy New Year to those of you guys watching, if that hasn't happened yet. So but yeah, let's dive into it. You guys, unless you guys got something that you want to say, you guys want to like leave them with some like words of wisdom before you get into it and come back to it, or you just want to just dive into it?
Let's jump right in.
Let's jump in.
Okay.
It's a wild time.
Let's talk about it. Let's talk about the news that's going on right now with the FHFA conforming loan limits. If you don't know what that is or what FHFA stands for, it stands for Federal Housing Finance Administration, which they do a lot of other things, but also set us up with what the conforming loan limits are going to be each and every year. This usually comes out just before Thanksgiving, and we saw a little more than a 3% increase, which is actually less than what we had been seeing in recent years. I think it was around the 5% or a little bit higher than 5% year over year prior to this recent change. But I'd love to hear your guys' thoughts on this change and what you guys think and how it's going to affect consumers.
I mean, with the prices of homes going up, especially here in California, it's definitely going to help people get into homes. I mean, it does make a big difference, especially like when you're doing a 3% down. You can go to higher purchase price now, or 5% down, higher purchase price.
Mm-hmm.
Even a lot of people don't know is when you have, well, this is when you have your if you get a 2-unit property, 3-unit, 4-unit, these loan limits increase, so it helps you when it comes to financing. So when it comes, let's say you're going to buy a multi-unit property, a lot of people don't realize this. Talk to your loan officer, figure out what the loan limit is. Like say I'm looking at it right now. Say a 4-unit property loan limit is $1,601,750. So that does make a difference when it comes to financing and how much you're going to be putting down as compared to, like, let's say if it's, this is a high cost on a 1-unit, it's $1,249,000, or what is it? We got the is that
it's 1.249 in high balance community.
Yeah.
That
So
purchase price gives you basically a 1.315 purchase price. So
just keep in mind though, the conforming loan limit for VA is only the single unit.
It's only good. That's only the single. I've seen a lot of people, not a lot of loan officers, make the mistake where they go, "Oh, this veteran's going to buy multi-unit property," and they use the 2 or 3-unit or 4-unit.
Yep.
No, the VA always goes off the 1 unit, no matter how many units they're going to go off that
Which,
loan.
Granted, it only matters if they have an existing VA loan, though.
Yeah.
If they don't have an existing VA loan, then none of this matters, right?
Right.
If you're a veteran listening, or you're a real estate agent that's helping a veteran through the process, and that veteran does not have an existing VA loan, and they're looking at buying a property with their VA loan at $3 million, as long as they income and credit qualify, nothing we're talking about right now matters. But as soon as that veteran has an existing VA loan and they come to you as Mr. Realtor, or you yourself as the veteran are trying to buy that property, and you have that existing VA loan, then these conforming loan limits come to play. Thus, you must follow whatever the county loan limit is in the area that you are buying the next property. So you're probably not going to have 1.2 million available if that is the county loan limit where you're at, because you have to subtract what portion of your entitlement was charged. Sorry, Nathan, I know you're about to.
That's a good point to bring up, because
it's good insight for our vets that are out there, right?
Major mistake, yeah.
I know both you guys, are actively engaged with a lot of veterans and whatnot, but for the average homeowner family that's out there trying to purchase a property, this is good news. I think the FHFA is a very, very good indicator of the health of the overall housing market, right? They're only going to increase property values in the event they see economic progress or they see improvement within the economic environment around housing. Now, we've seen in the past where property values and FHFA limits have actually been reduced on the heels of the recession in 2008. Josh, I don't know if you have a chart regarding this, but there was a couple of periods of time where the loan limits got reduced because of unfavorable market conditions. That was an anomaly. This is a good indicator that we don't have the sky falling. The market isn't going to crash. Those people that are in economic chair type positions and people a part of the FHFA that are mandating these loan limits, they see economic progress, right? But they also see a housing market that has sustained stability. Now, I don't want to say it's a healthy environment because that's a subjective thought process. I think that we're in an environment where the market is continuing to show signs of improvement. In the vast majority of the country, we've seen marginal improvement or property appreciation this year. There's only a handful of areas scattered throughout the country where we see property values come down. And I think that as a macro, the housing environment throughout the United States points to the fact that this is a good thing. For those people that are like, how does this even matter to me, right? What is the loan amount or loan limit? What does that mean to me? Well, what it means is that if you're in a conforming loan market, as a veteran, as a first-time home buyer utilizing a conventional, and I want to make sure we make that distinction because a lot of first-time home buyers are using FHA. Those FHA loan limits have not been released yet. Now, that delay is likely in connection with the government shutdown that we've had. I mean, this recording is as of December the 3rd.
Because that's HUD, right?
Because it's HUD, and HUD is a federal entity.
And HUD was shut down. HUD was shut down, which also affected USDA as well.
Exactly. So like we've seen an impediment in the release of that information on the heels of that government shutdown. We'll likely see that information published in the next couple of weeks before the end of the year. But all that to say, if you're a conforming buyer or a conventional buyer, this basically helps increase your purchase power. So on a standard, non-high balance community, a place like, in a normal suburb or a normal community, that purchase price goes, up to about $858,000 with 3% down. Now, if you're in a high balance community where you have to put down 5%, like in Los Angeles or Orange County or some of those higher premium, high cost communities, your purchase price is north of 1.3 million now with 5% down. So these purchase prices are crazy, but all things point to the fact that this is a good thing for families, a good thing for people in their ability to purchase homes. One of the biggest hindrances is down payment. So this just expands the buyer pool for some of those more expensive properties as we see houses continue to appreciate.
Do you guys
another thing I just thought about? Go ahead, Josh. Sorry.
Oh, sorry. No. Go ahead, Alex.
No, I was just going to say where you brought this up, it just made me think about how, for example, let's say you're homeowner and your loan balance is a jumbo loan balance. And with these increases in the loan limits, now you could potentially refinance into a conventional loan. So you high balance conventional. So now you can get a better interest rate. Qualifying is a little different. So that is a big advantage right there. So especially with us, especially Riverside has had a big increase in values. And my area too, Ventura County, LA County. If you're in jumbo loan, now you could potentially got to revisit it, talk to your loan officer, and maybe ask if you can refinance into conventional loan. That can make a big difference for you.
It's fantastic point. In addition to that, I think that the opportunity now is for those that have had to take out home equity lines of credit over the last few years, people that had to do combo loans in order to a first and a second in a higher interest rate environment. This is an opportunity to revisit your total cost on your current loan and compare it to maybe what a new reduced cost loan will look like under these new loan limits. So I'm seeing a lot of opportunity for cash out, for consolidation. As we all know, consumer debt is on the rise. It's the highest balances we've ever seen for consumer debt. Doing cash out refinances, fixing your budget as a household, reducing your overall liabilities. All these things are great, but these increased loan limits are going to give consumers and families more opportunity to expand their loan limits within the equity that they've earned on their homes. It shows that there's likely positive appreciation into next year, and it's going to help people, lower their overall budgets, which could improve your bottom line as a family. I'm helping a lot of people. The vast majority of people that we're serving here in Q4 within my business or my practice are people that are trying to reset their monthly budgets going into the new year, leveraging equity, consolidating debt, getting them into a more affordable budget moving into the next year so they can be more intentional with their finances moving forward.
Affordability, that was our term before. So I think affordability is a big one. It's going to be like this for a while. So
equity is a tool if you know how to use it. Just get with people like
100%.
Josh, Alex, or myself that can show you how to utilize that equity in a meaningful and strategic way.
Hey, Josh, you brought this up, the loan limits, the historical loan limits.
Yeah. Nate asked about it. So interesting thing I found here. So if you go, really back,
there was 417 forever. Remember
it
that?
Didn't go down, right? So so this is Wikipedia. Just keep that in mind. They did not post 2025 at the lowest. The most recent is 2024 on here, but 2025 was 806,500. But just for an example, it never went down, at least from what I'm seeing here. It kind of, you'll see actually here, it went down right here. In 89 to 90, it went down just by what, $150?
Yeah, by a marginal. And then in 92, it went down to 93, right?
Or no? You said 92.
No, they stayed the same. I'm sorry. It's just tiny on my screen.
From 92 to 95. Then it started going back up again. And then we get to 2006. It goes to 417 in 06.
And it stays
and then
for a
it
while.
stays exactly the same.
Over 10 years, right? Yeah, 10 years.
10 years till 2016.
Yeah,
and then it jumped up again by $5,000. So I asked ChatGPT for year-over-year gains for the last 25 years. So basically since the millennium, since 2000. And it says from in 01, we went up by 8%, 02, 9%, 3, 7%, then 3% in 04, 7% in 05, 15% in 06, but then stayed the same, all the, like we just talked about, all the way to 2017, went up by 1%, 6% in 18, 6% again in 19, 2020 was 5%, 21 was 7%, 22 was the biggest jump that I have seen so far, which was 18%.
Wow.
23 was 12%, 24 was 5%, and 25 was 5% again. And then this was now a
jump in like a property appreciation too during that time. It was a huge
correct.
Jump.
Right. We saw a massive jump.
Yeah.
So it's interesting, honestly, like when you read through what's happened. I've never read these figures like this over the course of a 25-year period ever. I've obviously paid attention to like the last 3 or 4 years because it's kind of what's affected us recently. But that's a wild. I don't know. Do you guys think that this was enough? I know we've been on this topic for a minute, but I'm just curious. Do you guys think that a 3% year-over-year increase is enough, and does it help? Because I think the biggest thing on a lot of consumers' minds right now is affordability, and I don't think people care that much about county loan limits. You see what I'm saying? Like, sure, an increase can help in other ways, but my question is, do you think that the everyday consumer sees this as, this is a huge win for me?
I think that this is a conversation that can get really deep, but I'll candidly, I think it's a massive step in the right direction. Here's why. We just got data that conveys that the average first-time home buyer is now 40 years old. People that are 40 years old oftentimes have kids. They're not like babies. They're usually like a few years old, these kids. We're seeing the first-time home buyer shift from what used to be like the move-up buyer. And the psychology of that buyer, the family that's the first-time home buyer now, that's been renting for a really long time, working their tails off, struggling to keep up with inflation and all the different things, chasing the dream of owning a home that's been running them or eluding them faster than they can keep up with it. Those people that are finally becoming first-time home buyers, they're in a space where they want what they want. And that house is within the realm of these conforming loan limits. Now, oftentimes they're even a little bit higher. Like if you're in Southern California, Alex is in SoCal, I'm in SoCal. The cost of that move up first-time buyer, it's kind of what it is. So I think that what we're observing is, and this isn't really talked about, is we're seeing that what used to be the first-time move up buyer, meaning that like they bought their first home, it was a shack, they fixed it up, they lived there for all their 20s and into their early 30s. Now they have some kids, they're getting a little bit bigger, they're selling that house and they're using the equity now to buy that move up home. That's the first-time home buyer. That first class or category of first-time home buyer that was buying a smaller home, doing a lot of renovations on their own, a lot of DIY, like that first-time grinder home buyer that was very young, that's kind of disappeared. So I think that this is reflective of A, property values, but B, the psychology of the families that are actively buying homes right now as first-time home buyers.
Okay.
Yeah.
I like how you came with my man came with receipts. He was like, I got this. Hold on.
Yeah. I mean, what you're saying, it does make it. Well, the average consumer doesn't realize how much this impacts them. Like how we were just saying about jumbo loans. For example, let's say the loan limit was still 417, right? And you're trying to buy a house for $800,000. You're putting whatever, you're putting, you can't put 3% down because then that would be a jumbo loan. That'd be a jumbo loan. So now you have jumbo guidelines, and who creates the jumbo guidelines? Not Fannie, not Freddie. It's the investor. It's a portfolio loan. They create their guidelines. So they're going to have,
that's a good point.
I worked for a bank for a long time, so we did a lot of jumbo loans. That's what we did for, that's what I focused on. And the guidelines are much more strict. They want reserves. It's all this stuff that the average buyer, the first-time buyer, would not qualify for. So with these loan limits increasing, that makes it, just like Josh was saying, makes it, or no, I'm sorry, that's what Nathan was saying. It just makes it more affordable to purchase a home, because if you're going based off these jumbo loan limit or these jumbo guidelines, it's going to impact your rate. The Kaizen program, can you get a 30-year fix? Maybe not. You're probably going to have to get into like a 7-1, right? And your average first-time home buyer isn't too crazy about that. It's going to be someone that has much more in reserves. They're okay getting a 7-1 because if something was to go bad, they got enough money to pay off their whole mortgage, right? And then the debt ratios, when it comes to qualifying, your debt ratios, you're conforming. What do you have? Fannie Freddie can go 50%, right? On jumbo, it could be you go to bank, they might reduce you to like 35% debt ratio, and they might want 6 months reserves, cash reserves. Who has that much cash reserves when they're trying to buy a house? Not too many people. So it makes a big difference. A lot of people don't realize how much it really helps them, but I think it's our job to educate them and make sure we put this information out for people to see.
100%. Let's move over to this other interesting topic that I'm curious to hear your guys' thoughts on. That is the president's proposal, at least, sometimes the things he just says about having a portable mortgage plan and how homeowners can move without losing their ultra low interest rate. So for those of you kind of trying to get a grasp of what a portable mortgage is, I'm going to tell you a 30,000, maybe even a 50,000 foot view in crayon of what this effectively means. But if you have a 2-3% interest rate today, and you have a house and you're kind of what we call golden handcuffs, and you're stuck in that home, but you really need to upgrade or maybe downsize for whatever reason, but you don't want to have today's mortgage rates, without saying what that might look like, you could potentially, air quotes, take that ultra low interest rate over to a new property, according to what the president is proposing. So I did some very brief research on this to see if this was ever a thing. And apparently in the US, we played around with this in the 70s and 80s, very, very minimally. It wasn't a common thing that was being done, but it actually quickly died out just simply because Fannie and Freddie were not supporting it. So I'd love to hear your guys' thoughts on, do you think this can actually gain traction and become a thing? Because my personal percentages, before you actually say your answer on whether you think it become a thing, I'd love to hear your answer on 0 to 100%.
We all want
100% chance being a thing, 0% chance not being a thing. So whoever wants to go first, just say your percentage. I know what mine is. I'd love to hear yours.
0%.
Alex?
It's 0, man.
So we're gonna go ahead and sweep the table.
I think
yeah.
0.
I think,
0%.
I mean,
okay.
So,
all right. So our next topic for today is going to be.
I think that this is a phenomenal. It's a phenomenal idea. It is a good idea. I mean, it's a nice idea, right? If you were to poll the average homeowner or the consumer, like, they would be all about and love this idea. And I think that it gets that type of attention. I think it's a positive attention garnering type headline. But the truth is, like, when you are going through the home loan process, there's collateralization or securitization, which is the collateral, the actual property and the equity, or the property itself that is collateralizing your loan. Now, by doing this, you're basically eliminating the securitization process of the home loan. Now, I've dug into this. I know that the viability is there. Now, there's a lot of other things that are in discussion around this, right? So not just the fact that my mic got messed up. Not just the fact that they're looking at a 50-year mortgage, or I'm sorry, not just at the fact that they're looking to transfer mortgages or a 50-year term or things like that. There is the discussion around whether Fannie and Freddie are going to remain as federally mandated entities, right? There's talking about privatizing mortgage loans, and that could essentially lower rates as well. So there's a lot of discussion around these things. This is I think a headline point that gets a lot of fanfare, but I think there's a 0% possibility that this comes to fruition. You would have to abandon the way that loans are underwritten with securitization. And I just don't see that happening.
Why is it 0 for you, Alex?
I mean, here's the thing. If it was somehow to ever even work out, right? So if it ever worked out there, so you have your whatever, you're say 3% mortgage on your house, and you want to buy the house, whatever, on the other side of the city, and you want to transfer your mortgage. So it's essentially, it's like a funky modification, this pretty much for the most part. There's any lender that would say, let's say this does work out. The customer is going to have to requalify for the loan. If it did work out there, it's not going to be like, hey, we transferred over to this house. Here's the note, sign loan docs. We're good to go, right? And I think a lot of people are thinking, hey, this is going to be a lot cheaper to do mortgages. You're not going to get rid of title, escrow, lender fees. All that's still going to exist. You're still going to have to pay all that. Maybe, I mean, even the real estate, the real estate agent, you're going to have to pay, their commissions as well. And you're going to have to go through qualification process, because any lender is going to be like, hey, just like if you refinance a loan, you live in the house, you've been there for 10 years. Lender, what do they always do when you want to refinance? Unless it's a streamline, they want to check your income, your assets, your debts, all that stuff, right? It's going to be the same exact thing. So what really changes in the whole process? I mean, it's going to be the same thing. And for the most part, people are probably going to be even more debt, and they're not going to qualify. Then they're going to get pissed. Like, well, I thought I could just transfer it over. There's so much to it, man. There's no way this is going to work out. I mean, if it does, I'll be really surprised. And if they do, it'll be for like a select type mortgage, maybe like an FHA loan or something. And even then, I don't even think that's going to be possible.
I don't think this claim was ever, or maybe not claim, it's not a claim. I don't think this statement that he made about this proposal was ever intended for it to become a thing. I think that this was just simply to
like an idea
play. I think it was a chess play. I just think his intention, he's smarter than that. I just don't think that everything he says is with the intention of it being a literal plan. So like, if you notice where they catch him saying things, he's on an airplane or he's walking to a plane. Like, this isn't him sitting down behind the big desk coming up with this major plan, because if it was, we would see more behind it. But he's on a plane and he goes, I don't know, I'm thinking maybe we just do this. And he's throwing out these ideas that I think he's trying to move the market. I think he's trying to jog the market.
Action.
Say,
He just wants action.
You don't want to lower rates? Okay, cool. I'm going to try to pitch something out there for people to keep their rate now. So I just think that the dude's a businessman first. And I think that as a businessman, you try to make certain chess moves to try to get that opponent to move. And right now, that opponent, when it comes to housing, because cost of living and affordability was one of his key pillars of his campaign, is leading up to this presidency. That was one of his key. I don't remember exactly where it was of his 47 Agenda 47 thing that he came out with, but I know that he talked about affordability and making things more affordable for the everyday American. So with that in mind, that's also why I feel like we're hearing so much about certain things that he says that are from an idea standpoint, is just simply to maybe like spark that opponent, and that opponent is Jerome Powell.
Yeah.
You know what I mean? Like, he's like, okay, cool. Like, you're gone either way, bro. Like, but I'm going to try to get the market to move.
I don't think it's singularly in the direction of the Fed or Jerome Powell. I think that, if you understand the way the mortgage rates work, like, they have an indirect, the Fed and the Fed rate and the Fed share have an indirect correlation with mortgage interest rates. This topic is specifically around mortgage interest rates and the affordability. The biggest crux in inflation has been housing, right? So the biggest crux being housing and the costs associated with that, it makes sense that the popular opinion would be to drive down the cost of the biggest component of the affordability index, housing, right? This is a headline or a title that does exactly that.
It's the largest.
In addition to pushing the Fed, he's trying to impact the macro markets, because the demand for bonds, mortgage-backed securities, and the 10-year treasury and the other treasuries that the U.S. is very much a part of, we need investor confidence and international investor confidence to continue to buy those bonds in order to drive the price of those bonds and give us positive correlation, so mortgage rates will come down. So I think all of this is to say, like, hey, bro, I got this. Hey, we're actively trying to be creative to create an environment where housing costs are more affordable, and buying our bonds is a good idea. And if you look at the bigger play, and I think, Josh, you hit the head on the nail with the fact that this is a chess play. If you look at the bigger play, he's talking about tariffs and trying to omit taxes and the income tax for most Americans. You pair that with international bond purchases and an international economy that drives prices upward because our bonds and our currency is performing so well, drives our affordability costs down here in the US. I mean, it's all a macroeconomics play. So to your point, I think it's a chess play. I think there's a 0% probability that this comes to fruition, but it's a nice talking point. And I think that it does jolt the market to show that, like, hey, the US is being proactive with what our biggest issues and concerns are, which is affordability, which is inflation, which is housing costs. That's on the forefront of our minds, and we're being proactive and being innovative to try to come to a solution and give the people relief. Continues to keep them popular also, which helps with the next election that's coming up in the next couple of years, and keeping this party in a very
next year.
The presidential election is what I'm saying.
Right, but I think he needs movement now. It cannot wait till 28.
It's
because he
him.
needs to
It's
keep
not
the
waiting
house.
until the election. It's laying the groundwork that, like, hey, our party is really getting after this.
Right. That's what I'm saying. You have midterms.
We need another runway. We need another 4 years with this administration or this leadership, right? Whether it's JD Vance or someone else, we need more runway to enact the things that were started just a few years ago. Give us more time. I think that's what
I don't disagree with what you're saying. What I mean is, I don't think it's more about 28. I think it's more about 26, because 26 is the midterms, and if they lose the House, he cannot be able to enact anything that he wants to enact, because then the opposing party is going to shoot it all down. It'll never actually get to his desk.
Well, we saw the resistance that we just ran into with the government shutdown.
That's what I mean. So that's why I was saying, like, the chess play. I know what you mean by the chess play for 28 for sure. I know he's trying to keep 28, but if he can't get 26, how can you implement anything for 28 to actually be viable? Because the goal is for when 28 happens, right? You've implemented things that the American people feel, not that you said, the American people feel.
If you win the heart of the people, if you think about it, the popular vote was Trump this last election, right? If you win the hearts of the people, you will win the hearts of the local officials to kind of go in the direction of what the people want. And that's what this is. This is a heart play. This is an emotion play. This is tapping into what people are feeling more than anything, which is the hurt that they're feeling in their wallets, especially here on the
Let's talk about his other claim then, because he also wants to make some moves with mortgages as well, right? With mortgage terms, I should say. So the other thing the president came out with, I mean, he came out with these two claims back to back. Like, it was like 1 week he said this, 1 week he said that. So 50-year mortgages are back in conversation as a proposed solution to America's affordability crisis. But while they shrink the monthly payment, there is a massive they massively inflate the long-term cost of owning a home. So I'd love to hear your guys' thoughts on this, because when I did some digging on this, and you guys probably saw this as well, it seemed like everybody was reacting to this in the way of saying, well, but you're going to pay, 2 times more interest over the course of actually owning that home over the course of 50 years versus owning it for 30 years. While I do look at some of those claims as a little bit extreme, because I just don't know anyone nowadays who keeps a mortgage for the term and never refinances and does anything with that at all. At the same time, it doesn't mean I'm in favor of a 50-year mortgage. I personally don't see, I don't see a 50-year mortgage being something that actually solves the affordability problem. I just think that what will end up happening is people will end up trying to just buy more house, regardless. They're just gonna be like, oh, I can qualify for more, so I'm just gonna go get a 50-year mortgage now.
It's a short-term solution to a long-term problem.
Correct.
And this headline should better read, U.S. home buyer becomes slave to lender. Like, really, that's what it comes down to. You're an indentured servant. The borrower
I saw someone else
lender,
say, like, you'll be you're a renter. You're effectively a renter for life.
I mean, in essence, that's what it's now. Here's the deal. I think that this is a phenomenal opportunity if it does come to fruition, if it's used as a tool. This is not a long-term mortgage solution. This is an opportunity to get in at a lower cost and maybe qualify for the home that you really, really want for your family. I mentioned a little while ago in our last segments that the first-time home buyer average age is 40 years old now. That first-time home buyer that's 40 years old, they have kids, man. They've been married for a few years. Like, they're in their careers. They're earning. We have a millennial population where a lot of them are high earners, but they're feeling the crunch of cost of living and all these things. This helps mitigate that liability for housing in a short term. Now, where the issues I see come into play is that this is going to impede your equity development over time. This is going to slow your progress for that move up opportunity, because if you're a first time home buyer and you're buying a house that kind of meets your budget right now and your family's needs right now, When the kids get a little bit older, or maybe you have another one, or hey, you need another bedroom, or hey, your aging parents now need to live with you and need more space. Like at some point, life will come into play and you'll have to transition to a new home. It's not often that families are living in their home for 50 years, 30 years. I mean, the average time in a home is about 7 to 10 years now. That's likely going to stretch a little bit with affordability being so low and costs and cost of living being so expensive. But 30 to 50 years in the same house, I just don't see that it's viable. Now, if you stay in that loan, yeah, you're going to pay a ton. And it's also going to limit your equity appreciation over time as well. So there's pros and cons to all of it. I think that it is a phenomenal tool if it's being stewarded by a family that is being led with wisdom and having a mentality of understanding that, hey, this is a short-term solution. We need to get you into a long-term mortgage solution after we get into the house, get a little bit of equity, and put our family into a more stable economic environment moving forward. It's just going to be hard to walk away from a cheaper payment. But people have to understand you're either paying for it now or you're paying for it later, or your kids are paying for it when it's time for them to settle up after you pass and the home gets passed down to them.
What are your thoughts, Alex?
Yeah, I want to bring up, we all saw this. Everyone saw this on social media. You had these gurus that really, they were saying, they're giving some information, and it made them look, I think, honestly, pretty stupid when they're talking about this, because now all of a sudden they became mortgage experts. And it's okay. They're in the industry. They can talk about this kind of stuff, but let's leave it to the experts to actually know what they're talking about, seriously. And even though a realtor could be selling 1,000 homes a year or whatever, doesn't mean they're expert in finance and understanding the way mortgages work. One, they're doing comparisons. They're saying, hey, let's say that a 30-year mortgage is 6.25%, right? Let's do a comparison, 50-year. And they were doing the same exact rate, 6.25%, or people were doing these comparisons. And they said, okay, this is how much the difference in payment is. Right away, as soon as I saw that comparison, people are posting that, first thing any loan officer knows, it's not going to be the same rate. It's going to be a higher rate, right? So a 6.25% and a 30-year fix, if it's going to be 50-year, it's probably going to be like 6.75. So the amount of interest you're paying is even more, less principal, obviously. So you're not buying down the loan balance as much as you really thought, right? With that kind of comparison, that's a little foolish there, assuming it's going to be the same rate. Another thing, there's a lot of red tape with this. People, that's another thing. You have Dodd-Frank, they have qualified mortgage, QM. A qualified mortgage cannot go over 30 years, right? So this would be a 50-year loan. This would be a non-QM loan. And a non-QM loan, any lender that does non-QM financing, their rates, they're not what conventional rates are at. They're much higher. So even when you do the comparison, you're saying, hey, 6.25%, maybe 6.75%, it was a 50-year. Could potentially be that, or that's the thing. It's going to be much different when it comes to qualifying. We were saying how we're talking about jumbo loans earlier. Jumbo loans, and then you have non-QM loans. Non-QM loan guidelines are going to be much different than your Fannie, Freddie, VA, FHA type guidelines. So there's a lot of red tape. Even if they did do this, they would have to change Dodd-Frank. They'd have to make it a qualified mortgage. I don't see them doing that. Maybe there could potentially be a non-QM loan that does this, but I'd like to see what the guidelines are and how challenging it is to qualify. It could be, like you're saying, it could be maybe for a certain set of buyers, and it might work out, but if for short term. But for this to actually happen, I don't see this actually happening. Just like the portable mortgage.
What do you? Okay, so we said 0%. I have some stuff else I want to add to this. I'm just curious, real quick. We said 0% for portable mortgages. What are your chances on this?
On this one, I want to say 0.
I'll tell you mine first. I say 5%.
I was going to say 10% actually.
I say 5% on this.
I want to say 0.
I actually
the thing is,
see
I
this.
think there's a chance, only because this was when I was first in the industry. They rolled out, they had the 40 years. They actually had rolled out 50 years, but but the
for
thing
the
was,
loss mitigation.
Yeah, so it was like
right.
It was a 30-year loan. It was a 50-year loan due in 30. So you had a balloon. Another thing, they can't do that right now because that's still that's not a qualified mortgage, because you can't have a balloon payment for a QM loan. So that's a way, maybe if they they changed Dodd-Frank, they made it say, hey, it's a 50-year amortized loan due in 30. If they did it that way, I mean, that's a way they could possibly do it. I think that's that 10% that I think that could kind of get through in there if they did that.
What's your percentage, Nate?
Go ahead.
I think there's like a 30% chance this happens.
Oh, that's a big number. Please tell me more.
Yeah, I think
Please
that
tell me more. That actually surprised me. I saw the smirk on his face, but that surprised me.
I think there's a 30% chance this happens because, again, you got to look at the chessboard, right? They've already tried to do away with the CFPB, right? Doge found that there was poor spending there.
Them out of the way because that's
them out of the way,
pillar that would have to move.
There are a lot of proposals already, even before all of this, about revisions to Dodd-Frank and conforming guidelines. I said in another segment that there's a lot of discussion around Fannie and Freddie no longer becoming government entities and mandated by the government, but becoming privatized companies, right? That way they can sell stocks on the stock market, and mortgage-backed securities as an index are now a stock, which changes the whole paradigm with the way that rates work, right? So it makes them more tied directly to the way the Fed Treasury works, because if the Fed Treasury rate is lower, then effectively Fannie and Freddie can lend money at a lower rate, right?
Sure.
It makes it more connected to the Fed Treasury. So I think that we are in the midst, 2025, 2026, 2027, we are in the midst of an economic shift that is something that we've never seen before. There's no playbook for this. I think that with the innovation we've seen around AI and all these different things, you're going to see a lot of industry change. But I think that the way things have been done isn't going to be the way that things are going to be done into the future. And I think that this has more weight because it does solve the affordability problem with very minor implementation.
I'm with you on this, actually. I know what I said earlier and when we started this, but like the other aspect,
it's more viable than non-securitization. This is a viable solution that requires very subtle
portable
adjustments.
Mortgages, you mean, right?
Yeah,
So,
mortgages.
Because
this is a much more viable solution. I think that there's a 30% chance. Sure, to Alex's point, and not to throw Alex under the bus, but
no, please.
What they're proposing are the revisions of everything that he said throws this out the window. They're proposing that. So I think that there's a 30% chance that this can come to fruition. Yes, there's a lot of
30-year mortgage become a thing?
But I think it can happen.
When did the 30-year mortgage become a thing?
I want to say it was
in the 30s.
Yeah, I was going to say the 30s or 40s after
part of the New Deal. It was part of the New Deal. Do you know why? Because it came after the Great Depression.
Yeah.
People could no longer afford to buy homes and put 50% down and have a balloon payment.
Yeah.
So this was their way of reacting to the new way of affordability. So while 50 years sounds absolutely insane to have a mortgage, again, do people keep a mortgage for that long without refinancing or selling? On average, the average homeowner will move 3 times in their lifetime and live in a home about 11 to 12 years. And if they are living in that home, they're probably going to refinance at least once. But let's just say, because technically when you sign that term, you're under no obligation to sell and you're under no obligation to refinance. 50 years sounds absolutely insane. However, I know I said 5% before, and my 5% claim came from, here's why I said 5% though. My 5% came from the fact that it would take so much movement of all the things that Nathan alluded to, CFPB, that would also require Dodd-Frank and HUD, right? And then you also have, because then you have FHA that would need to adjust their minimum term. You need
FHFA that
adjust their minimum term.
Would follow in
so that takes so many dominoes to fall to happen. And do you think that that can realistically happen over the course of these next, year? We're pretty much through year 1, bro. Year 1's done. We got 3 left. Do we realistically think that can happen? Can it happen? Yes. But that's why my 5% claim came from that. Do I think it can happen? But I went on this rabbit hole because I do think that it's an interesting idea. But I don't think that, I think there are far better things that can be done in the place of adding or increasing the term to help affordability by, like, for example, allowing people to be able to pull permits faster and decreasing the permitting process so that builders can build more affordable homes. And
I don't think that's a solution.
I think that's a better solution than a 50-year mortgage, because helping builders be able to build more homes, especially. Go ahead.
I actually have, you guys have probably heard this, is either reducing or removing LLPAs. You do that.
I think that's
yes, I think that's
doing
correct.
that.
Like how much would
doing
you
that
guys
game
say on
changer.
average right now in
loan level
LLPA?
pricing adjustments, just for those that aren't aware of what an LLP is. Basically, when you qualify for a mortgage on an interest rate, there are adjusters that the investors, Fannie, Freddie, FHA, VA, there are adjusters that affect the bottom line of what your interest rate is. So when you qualify, that's why when you're asking for what the average rate is, like it's dependent upon your financial profile, because it depends on how much money you're putting down. It depends on your credit score. It depends on, the term of the loan, a 30-year versus a 15 versus a 20. All these different elements comprise what your ultimate benchmark pricing is. Those adjustments are called LLPAs, or loan level pricing adjustments. And it's an internal thing that lenders use in order to price an interest rate. So I agree. If you eliminated all of the adjusters that inflate the interest rate, it would definitely help the cause. I think I agree with you. I think that the discussion around building and housing shortage, I don't think that is the long-term solution. And here's why. Population is showing not an increase, but birth rates are coming down, bro. Birth rates are coming down. The average household size is shrinking. We have a boomer population that has just been chilling in their houses that own 3-4 rentals. The mom and pop landlord is a real thing. They comprise a large percentage. Like we talk a lot about the conglomerates, I think it's like corporations and hedge funds that own rentals. Yeah. But the mom and pop investor is a larger percentage than even the hedge funds. And these are boomers that have been hanging on to these properties for a really, really, really long time. And then when they pass, they're going to pass them down to their kids. And if their estate is established properly, those homes are in a trust, and there's no taxation. There's no property increase, property taxation increase on those. There's no taxes or transfer. And if it's set up right, the rents will continue to come in, get paid to the trust, and as a distribution to the recipients, right? Now, it's not to say everyone's going to do it that way, but if it's done that way, those houses aren't churning and being sold on the market in order to create more housing availability. So I think that, the boomers are the ones that created all the regulations that, no hate to my boomers that are out there, but that generation is what created our current environment. It's the truth. The regulations,
Social Security.
Yeah. It's the truth, bro. They're the ones that have created this. And they're the ones that are also holding on to a lot of inventory, holding on to their low interest rates with their very low taxes. I just pulled property profile on a house just yesterday for a client. And they bought this house back in 1990. Their property taxes have been getting a marginal increase since 1990. The house's initial assessment was $100,000. This house is worth over $1 million, and their taxes on this house are $2,000 a year in California. How does that compute? For a person like me that just bought $1 million house, my taxes are going to be $12,000 a year.
Yeah.
But they're paying $2,000 on the same house in my neighborhood. How does that make sense?
My taxes are $12,000 a year, and I bought half of that, less than.
You see what I'm saying? So how does that compute if you're living in a multi-million-dollar house as a boomer just because your timing was better and it's just the way. There's just too much of that, and I think that building isn't the solution. It's
next week we're going to talk about what DeSantis is proposing. We're gonna do in the next pod. We are going to talk about DeSantis proposing. And he's very adamant about this on trying to eliminate property taxes in the state of Florida, which then would be the only state to have both no income tax,
state income tax, and no property taxes. Yeah,
and he is very adamant about doing this, and he's very he has some realistic, I think, ideas about it. So we're going to talk about that on the next pod because it's a really interesting thing that I think could happen, and I would be okay with a consumption tax. I would be okay with my sales tax,
your annual property taxes, and your.
I would be okay with my sales tax on everything I buy being freaking double or triple.
Yeah, I think
I would rather have that than because then at that point I'm paying taxes on the things I buy versus on the thing that I live in every day.
There's a bigger problem with that. We should dig into that another time.
We will dig into that. We have some other stories that we want to cover, but I think we're going to save this for another pod.
Sure.
Thoughts, concerns, feelings?
Yeah, we can do that. We got
sure.
Yeah.
Can you guys hear me?
Let's say this for another episode.
No, we're good. I slowed down there for a second.
You froze.
You might need to redo your intro.
Why would I need to redo my intro?
Because you announced all 4 or 5 of those stories.
That's okay. They're still here.
Okay.
If someone is watching,
it's okay. They'll come back for the next ones.
at minute 45.
You're going to keep all this in there? All right.
For you, for the person. No. Here, watch this. This is how we're going to do this. For the person
you
watching
matter.
it.
You matter.
Listen. No, be quiet. Listen. For the person watching at minute 45, I want you to tell you a secret. I want to tell you a secret, okay? You go to the pinned comment. I'm going to put both of the articles for the stories we didn't cover in that pinned comment, but only you know this, okay? All right, got it.
I like it.
There you go.
See? Problem solved. And we'll cover it on the next episode.
Word.
All right, so we figured it out.
Right.
So they just have to remove LLPAs, and then we're good, right?
That's it. LLPA
that,
problem solved.
Everyone
I still say build more homes, but
the average market rate would go down a ton, bro.
I still say build more homes.
Like right now, the average rate for conforming is 6.23% as of today. If you got rid of LLPAs, just with the current market condition,
you're under 6.
You're probably closer to 5.5.
My last argument to your claim about just LLPAs instead of building more homes. I'm not saying LLPAs. I'm not saying building more homes over LLPAs or vice versa. What I am saying is, even though the birth rate is going down, like people aren't having as many kids as before, in America, we still take in over 1 million people annually legally. Preface that. Legally. So if we still are bringing in 1 million people to this country legally, those people are having kids. So people still need a place to live if they're coming into this country. And so even though we're also not having as many kids, you add that on as well. That's a compounding effect that will happen over time.
Yeah, I could see that. I think that that's a way loaded discussion,
I know. I'm just this, like I said, I'm not saying it's not in substitution.
I didn't want to bring something up. So in Ventura County, the board of supervisors, they just voted. Was a few weeks ago, and it passed. So they're streamlining the process for permitting, because currently, right now, the way it works is if whatever you're building, a house, an ADU, anything, everyone goes through the same process, and it's super slow. Everyone knows
Which
it's
means
it's
if you're
terrible,
not related
right?
to Karen Bass, you're not going to get your
permit. It's
permit.
relatively faster than anywhere else, right? But what they're doing, they're getting a one point of contact person for so let's say if you're trying to add an ADU, right? You're not going to have to go through the same process of someone that's trying to build a house or build a commercial building. Right now, it's all the same. So they have a single contact person for, like, say someone wants to build an ADU, that person handles all that. Someone wants to build a house, that person handles all that. So it's going to be a streamlined process. I mean, you brought it up, and then it reminded me, because I did some content on this just last week, and I didn't realize it was such a big issue. I mean, I know stuff gets, it goes slow, but they actually voted on this, and so they're working on the process right now, and it's going to be a streamlined process. So to build, people are going to be able to get permits a lot faster. We'll see how it actually turns out, how much it helps. But they did that.
That's local bureaucracy, bro. And the reason that I say that the permitting process isn't simple, or it's not the solution, is because there are thousands of counties across the United States, and there's no way to get. First of all, you've got federal and state law that are separate. Then you got state and county laws that have there's just no way to impose a loosening of guidelines around permits, because every county is different. They have their own guidelines. They have their own, population requirements. Like, there's a bunch of different things from county to county that, like, blanket guidelines for counties is just not viable, I don't think. And permits have to be done at the county level. They can't be done federally or at the state level because of the nuances with each individual county. And then there's also permits at city level. So, like, there's so many layers of permits. That's what makes it so cumbersome, is the layers of bureaucracy.
Yeah.
And I just don't know that there's a way to streamline that with the current bureaucratic system we live in. Maybe it's possible. Maybe I'm just not seeing the big picture here, but there's just too many layers, I think, for permits to be the solution. I think that if the Fed is going to do anything, if the government's going to do anything, if the FHFA or the Fed Treasury, or like whoever is going to do, we need big milestone movements. And I think these proposals we talked about today are they're blanket solutions that could be done at the governmental level that impact everyone, not just at the county level. So I don't know. That's just my take on it.
Yeah. I mean, it's something like,
all right, guys,
like in LA County,
that's your real take
happening in LA County at all.
I'm going to shut us down here.
Okay,
cool.
We've had a lot.
Great updates next week.
Episode. Yes, we got updates for next week if Alex's PJ lands on time. We'll see.
Oh man.
Yeah, but that's our take, guys. I thank you guys for watching this week's episode. It's good to be back. Good to be hanging out with these two fellas here. And I hope you guys got value out of this week's episode. If you did, let me know down below in the comments what you got from this. And if you didn't already, like and subscribe. We'll see you on the next one.